Joshua, thank you so much for speaking to us. Overall, just your sense of where the market is headed. At some point, I thought we were going to close lower, but interestingly, we saw a move to the upside. Does that, for you, signify some latent interest in the equities market, or do you think this is just a one-off? Because, as you know, the market has really struggled to get going this month.
Yes, well, the thing is, we can't really say that this is an indication of positive sentiment from investors because the market, like you said, has been a little bit volatile. However, I think looking back at where we are coming from, we saw quite a lot of positive sentiments earlier on in the year, but I think due to the fact that we've seen a lot of, happenings in the international space, we're going to continue to see some volatility, at least in the short term.
So, of course, we're talking about things like the oil price, and that obviously makes a lot of investors jittery. Exactly. But let's focus on the banks, because that was supposed to be story of the first quarter, the banking sector full-year results and their impact. There should be this rush for dividends. Do you still anticipate that we're going to see that aggressive interest in the banking sector that could lift the market? Given your expectations for this earnings season?
Well, yes, I think overall we do still expect to see some interest once the big banks release their results. From the indications we've gotten from the banks that have released their unaudited results, we saw some fairly positive results, but nothing really that shook the market, so to speak. And because there was no declaration of dividend, we couldn't see really a reaction.
But are you still optimistic that we're going to see those high dividend yields when they do declare dividends? And many will always point to Zenith Bank as being one that could deliver double-digit dividend yields. And in the current fixed income market environment, that clearly should be attractive to some investors.
Yeah, of course. So the thing is, we still expect that at least year on year, those banks, your Zeniths and your GTBs and what have you, should do at least a similar level of dividend, but they shouldn't go lower. Now, if they go higher, that would be a pleasant surprise and it would boost the market significantly. But we do expect them to still deliver those solid dividend yields.
But overall, what's your view on the banking sector? Is there more to be worried about, or do you think it should be more of the same in terms of maybe moderate growth in 2020?
Well, yes. So in terms of year-on-year growth, the level of growth we saw in 2019, or we're expecting to see in 2019, we do not really foresee that recurring again in 2020, simply due to the fact that the operating environment has changed. The policies have changed.
But do you anticipate that we'll see perhaps weaker earnings this year? As you said, the market has changed, right. But some will point to, and I wonder how you're reading this, the sharp drop in the fixed income yields. Right. How positive or negative would you say that is for banks?
Well, obviously this will affect, their interest income from trading securities and things like that. However, overall,
but potentially there is a spread in terms of how. Yes, of course, in terms of their investment opportunities, if they were to invest in fixed income securities. But on the flip side, if there's generally lower interest rates and the lending rates haven't come down as aggressively, then there should be a spread that should benefit the
fair spread. However, you have to remember that these banks are being encouraged, let's say, to give out more loans. So they would have to be a little bit more competitive in that space. So that might, reduce that a little bit more. Now, in terms of just interest income and, the yield environment currently, I think, sure, it's going to have a bit of a negative impact, just a slight one. And I think overall, what we might see is just non-interest income, maybe a little bit lower.
Are you concerned about the formation of non-performing loans this year compared to last year?
Well, I mean, banks have been quite prudent in, risk assessment recently.
But it seems that there is this pressure to lend.
Yes.
And then, of course, when you take a look at what potentially they would earn in the fixed income market, there is also that subtle pressure to look elsewhere for yield. So overall, how do you see this impacting the formation of non-performing loans?
Well, there might be a slight uptick in non-performing loans year-on-year, but I do believe that the banks will be prudent enough to keep it within a reasonable band. So we shouldn't see more than maybe 500 bps.
All right. Well, let's leave it there. Thank you so much for the insight today. I've been speaking to Joshua Odebisi, banking analyst at Vetiva.